All right, today we're going to talk about how to profit on long straddles, using gamma scalping. And if you're not familiar with the Greeks, it's okay. We'll be able to guide you through it without worrying about that. All right, first we're going to start out with our disclaimer. Just want to tell you, Options Authority, we're solely an educator providing training in the theory of analyzing financial markets. We're not a registered investment advisor, therefore we don't give out one-to-one advice like, hey, this is a good trade, do this specific trade to one person, okay? All of our training is based on theoretical analysis of markets and theoretical examples of how someone might choose a trade based on those theories that we teach at Options Authority. Okay, but what I tell everyone is the best risk manager in the world, look in the mirror, that's your best risk manager. You know what your net worth is, what your financial planning is, and you know how much you can commit to the market, because there is risk in everything you do in the marketplace. The more you know, the less that risk is, but there's always risk, okay? If you know nothing about options, the Options Clearing Corporation, the Securities and Exchange Commission, and FINRA all have pamphlets that give you the basics, okay? And lastly, I just want to say that our personnel may own positions or trade in the securities mentioned in the information that we provide, but all of our employees are prohibited from engaging in any transaction that directly or indirectly is in conflict with the interests of our subscribers, okay? So we're not going to do any front running, you know, or if we want to get out of a position, hey, here's a good one to take, you know, we don't do any of that stuff, all right? And Reed pretty much covered my biography, so we'll go on. All right, first of all, before we start with the topic today, I just want to tell you what's the core of our business is the one-on-one options mentoring. All right, this is where we teach people how to trade options the way a professional trade, to have the knowledge base that a professional option trader has. Okay, it doesn't mean you have to sit in front of a screen all day long. If that's what you want to do, that's fine. There's some of our students have done that. But if you have that knowledge base, you're going to be able to think on your own, and you're going to be able to do two things. One, if your trades are going against you, you're going to know the best way to minimize those losses. Okay, and number two, just as important or more important, if you have a trade going in your favor, you know how to not just make the most out of it, make extra than that. Okay, you can convert it into a different kind of trade. You're minimizing your risk that should the trade start to go against you again, and you're adding value as it goes along. You want to be able to drain out every nickel of profit on a trade because not all trades are winning trades. Okay, so you'd be mastering the fundamentals of option trading and advanced option strategies, okay? And then we have you set up a simulated trading account where we work with you to keep track of certain things, and you learn from mistakes and from the things you do well. By the time that you're done with our process, you're ready to use real money in a live trading environment, okay? And once again, this is all done on a one-on-one basis. I think hopefully you're going to get a lot out of what I teach you today. But a one-on-one basis is not going to be, well, should I raise my hand or shouldn't I raise my hand, or, you know, or should I say something, or, you know, it's very one-on-one. Okay, so on top of that, you get a 1 month peek at it. If it's not for you, you get your money back. Okay, and just log in the special offer. optionauthority.com/mentoring. Okay. All right, and just on top of that, we're giving some subscription products. Our weekly options workshop, that's a weekly webinar where we show you how to place a trade, monitor it, and adjust live trades. Trade alerts are mailed throughout the week, so we show you a trade that we're establishing, and then the adjustments we make throughout the week. Okay, we go back the next week, review it, put out a new one, and we also give you a new strategy to look at every week. Okay, so that's a great thing, the weekly options workshop. And our options marksman, that's real-time options recommendation service delivered via email. You get about 6 trades per month on that, and you get a weekly market report. That's done by John Lewis. He's not quite as old as I am, but he's been around a lot and he has a lot to offer. Okay, that also is a free 30-day trial. Okay. All right, so now we're just going to cover what we spoke to earlier, how to harvest profits from trading straddles. Okay. Is anybody in there? Is anybody here traded straddles before? Okay. Okay, we got a few people here. All right. Good. All right. We're going to first going to show you exactly what they are and then how they work. Okay. All right, here's the basics. All right. You buy the at-the-money calls and puts. Okay. Okay, so if you do that, if you buy the at-the-money calls and puts, they potentially become, let's say right here. If you were to do it today, we'd look at Twitter. Okay, at-the-money calls and puts. For about $3.64, you could pick it up. Okay. The risk is limited to the premium that you pay. That's the beauty of a long straddle. The bad part of a long straddle is sometimes it can go to zero if it goes right out of the strike price. But the beauty of it is at least you know what your risk is. And because of that, the margin treatment isn't too onerous. All right? It's just the premium you pay. Now, the possible profit, since half of that is a call, to the upside, it's unlimited profit potential. Okay? I've never seen a stock go to infinity because I'd have to be around for an infinite number of years. But I was a market maker in Cisco in the 90s, and that would split a couple times a year. Okay, and it just didn't go up infinitely, but boy, it sure made a lot of progress to the upside during the time I was a market maker there. All right, to the point actually where I think in 2000 it was the biggest corporation in the world, and it had a PE of 125, insane PE. So at some point it would collapse, and it eventually did. Okay. So you have unlimited to the upside, and then continuously increasing dollar amounts to the downside. Okay. I don't know if you remember in 2007, Bear Stearns, big investment firm, been around for a long time. Okay. They've been around for a long time, okay? And they're about $130, okay? And when it was that liquidity shortage, it was like a precursor to the meltdown in 2008. But that went from $130, opened the next day at $2. All right. Eventually got adjusted to $8 when the government kind of gently pushed J.P. Morgan Chase to buy Bear Stearns. Okay, at $8 instead. But anyways, 130 to 2 or 130 to 8, that's a huge profit. Okay. You don't go into these long straddles based upon that. Okay, because it's just it's a needle in a haystack. Okay. But it does happen. Okay. Even in a stock that's considered a musty old boring stock that nothing ever happens with. Okay, even a stock like that can go down to near zero. Okay. Okay, Eddie says, do you sell the losing side if the stock is moving one way on the direction if it's moving one direction aggressively? You could do that. Is it worth selling out of the money put and call to reduce expenses? It depends. That's a component of what you can do. What we're going to show you today is what you can do without touching the options, okay? Eventually, as you get more experience, you use it all. You use the stock, you use the options. And the beauty of using the stock against options, if you have X amount in your account, and I don't know who you're putting your trades through, but call them up and say, okay, what do I need to do? In other words, if I'm long a call and I short stock against it, all right? We'll go by this example here. For Twitter, for instance, about 38 bucks. Okay, if you were to short 200 shares of stock, it would be over 10,000. Okay, you'd have to put in close to $11,000. You'd have to put in. Okay, because with that, it's 150% margin. Okay, just a short. So 10,000 or two. But if you have a call against, it depends on how frequent. If you have 25,000 in an account, you can short stock against a call, and they will treat that as if it's a put. Okay, so instead of 10,000, it might be $250 in margin it would cost you. Okay, so not a lot. All right. So. Okay, so you can see, now the beauty of options, long options, when you're trading long options, is the leverage it gives you. Okay, I just showed you with the two puts would cost over $10,000 in margin, and with the 200 shares of stock, it would cost about $7,600. Okay, and yet you can do, it's just the margin is just the price of the premium. The premium is way smaller. I think we showed like $4 premium for one straddle, $400 per straddle. Okay. The bad part of being long, the leverage that gives you, is it's a wasting asset. Long options are a wasting asset. Okay, they're constantly decaying. Okay. So so that's what we want to see what we can do to help with that thing. Because you can slap on a straddle and hope it works. And if it doesn't work, you can just lay in the hammock. If it works, great. If it doesn't work, not so great. But in times of uncertainty, the time value can actually increase with the passage of time. Okay, you could be long a straddle, and all of a sudden that stock is in the news for something. And what you paid for $4 for it yesterday, it might be worth $6 tomorrow because of the uncertainty. That's what the time difference about an option premium. It's all about uncertainty. Okay. All right. So what we want to look at in all this is we want to look at the implied volatility for the at-the-money options. Okay. Now, implied volatility is kind of a reverse engineering process. Volatility of a stock is just the history of its movement. Okay. Implied volatility is implying how much future movement there will be in the stock. Okay. And that's done by looking at the price. You look at the at-the-money straddle, and that will imply how much. Here, we'll give an example here. So this, let's say 38, it's worth about $3.60. Okay. So basically, and that's with about 42 days left till expiration. Okay. So over the next 6 weeks, it's implying that the movement is going to be about $3.60 in either direction. Okay. So the market makers are coming together. Now you take that $3.60 and you look at it up and down, and that gives you the implied volatility. Okay, that's implying what the volatility. So it's a reverse engine. They look at the options prices. What that means as to how much the stock will move over a given period of time, and then they plug in that number. Okay. So sometimes the historical volatility and the implied volatility be different. Sometimes not. All right. Okay, here's a good question from Eddie. How long of a time, days, weeks, months of options do you use? And what day of the week do you place your trades? Thanks. The day of the week doesn't mean that much to me unless there's something big going on. Okay. Because as you're going to see as we put these trades on, we put them on and then we look what to do after they're on. Okay, so it's, at least I've been doing this for 35 years, and there's no magical day of the week that I've found yet. Okay, if there's news on a certain day of the week, for instance, if you're trading agricultural options, okay, options on wheat futures or corn futures or soybean oil futures or soybean, just a regular bean futures or bean meal futures, you might want to put it on a week before that crop report comes out, okay? Because if you do, like I said before, it's a wasting asset. Until that news comes out, it's generally not going to lose anything. Okay, the normal wasting or decay of that option is not going to happen. Okay, I hope that answers your question. Yeah. So we look at the implied volatility for the ultimate, determine the total amount of time value in the position. Okay, and we check out the past movement in the stock. Okay, so it's kind of like we're looking at historical volatility, we're looking at implied volatility, and we're looking at, all right, if we are going to put on one of these straddles, what's the dollar and cents amount that we're going to be on the hook for? Okay. So, and here's what we're going to look to do today, show you how we do today. As stock travels higher, position becomes more like long stock than short stock. That makes sense, right? Eric has a question. Well, Chris has a question. Could we walk through one trade? We're going to walk through a few of them. Okay. Can we use indexes? Yes, you can. Well, indexes you cannot. Excuse me. Not if you're gambling scalping. All right. You could if you use a deep in the money options. You could. But there's no underlying. There's with a stock ETF or futures. If you're trading options on them, you can trade the futures, the stocks, or the ETFs against the options position. Right. Now with an index, you can kind of create your own, but it's not as easy to do. That's kind of, I'm kind of biased towards trading an ETF versus an index if they have the similar characteristics that you're looking for. So. All right. So as the stock travels higher, position becomes more like a long stock. I mean, think about it. The Twitter example gave it 38. If it goes up to 45, it's going to be a lot more like long. It's going to be more likely we're going to exercise that stock, that expiration, than we would exercise the put. So higher it goes, it becomes more like stock. So okay. As the stock travels lower, it becomes more like short stock than long stock. Okay, because if you exercise puts, you're going to wind up with short stock. All right. So the further it goes down, the more it behaves like short stock. The further it goes up, the more it behaves like long stock. That's the beauty of this position is anytime stock goes up, you want to own as many shares as you can, right? Well, as it goes up, these equivalent shares become bigger, okay, because it's a greater percentage chance of them finishing in the money at expiration. So as the stock travels higher, you can afford to short some stock against that position, okay? Now, why would we do that? Because usually stocks, ETFs, futures, they don't move in a straight line, okay? Sometimes they do, okay? And if it's done in a gap way, we love it, okay? But it's usually not straight up like this, okay? It's usually, so it might eventually get to that same point, but it's jagged along the way, okay? And it's this theory right here, this jagged up and down movement that a stock, ETF, or futures contract makes. That's what we're going to learn to harvest that jagged movement to help pay for that leverage that we're buying, okay? Because if we do nothing but buy a straddle and lay in a hammock, well, we better be right. We're going to be out a lot of money, okay? Okay, somebody asking, can you use it with candlesticks? Yeah, technical analysis you can use this with. Okay. it's what I usually use is delta neutral trading, which doesn't mean that I'm always, for those of you who aren't familiar with the Greeks, delta neutral trading is, as I said before, as it keeps going up, the calls become more and more like long stock because it's a greater percentage chance of finishing in the money. That percentage chance of finishing in the money is called delta, okay, or equivalent share position, okay? So if it's right at the money, it has a 50% chance of finishing in the money. Which starts jerking up, that has an 80% chance for the calls and only a 20% chance of the puts. Because the call and put is going to add up to 100%. Because you're either going to exercise the put or the call for this. So that's kind of what I follow. It doesn't mean that I'm always exactly the equivalent share position of 0. But that's kind of what I base it on and then make a decision. But yeah, people integrate technical analysis into this trading as well. Okay. It's kind of like swing trading, but you have insurance policies built into it. Because with swing trading, it's hard to do it over a prolonged period of time, okay, because you could have those gap movement that you're not protected in. Whereas this, if we're shorting stock against some of those long calls, and all of a sudden it gaps way up, it's different, okay? Whereas if we were just trading the futures, you know, we sell at this level, it pulls back, we buy at that level, and we kind of go back and forth within that area. This is something we can do on a daily basis against the core position of options. What criteria do you use to select the strike price? Well, the strike price is always going to be the at the money, okay, when you're establishing these long straddle positions, okay? It's going to be at the money, so it's going to be equal chance of going up or down. It's kind of like the idea of what a straddle is. You're straddling the fence. Okay, you're not really sure which way it's going to go. Okay, so that's what you look at. You look at the good question, Boa. What is the goal of gamma scalping? The goal of gamma scalping is to make money off of your position. Okay, and we'll get to that just in 1 second. Okay. So here's a typical long straddle position, okay? And here you see it on both. You see the upside break-even point, okay, right here. And we see the downside break-even point right here, okay? So if it moves enough in either direction, if it moves here, then the combination of the call and so if we just bought a put, the downside break-even point would probably be more like here. Okay. If we just bought a call, the upside break-even point would probably be like here. So we're pushing our break-even points further out. But guess what? We don't have to be Kreskin or some other fortune teller. Okay. We're not really sure which direction it's going to go in. Okay. So because of that, we have to pay that extra amount of money for that leverage that we're getting to either side. Okay? All right? So that's what we're looking to do. Okay. Are your profits always outweigh the losses from your losing side leg? Well, the way to look at it is as a package. Okay, when you have a straddle on, look at it as a package. Don't think this side's losing, that side's banking, because it's all one thing. Okay, and as you learn more and more complex option strategies, you can't afford to look at your option position as components. You look at it as an aggregate. Okay, and as an aggregate, here's your downside break-even point. Here's your upside break-even point. Okay, does that answer your question, Eddie? I hope that answers it. As we go along today, it'll probably give you a little better idea of what I'm talking about. Okay, but basically that's it. Okay, it starts out like this. You know, that little smiley graph is what we call long straddles. Short straddles is the exact opposite. We call those frowns. Okay, even though this is a smiley graph, if it just sits here, if you do nothing between now and expiration and just sits at this level, you're going to pile up some big losses, and that smile is not going to be a, you know, a very big smile. As price goes in one direction, would you take off the other side to reduce loss? It depends on that, okay? Because as I said, it's a jagged motion. So it's going in one side, but then it pulls back. So as soon as it goes on one side, in other words, it moves up the call side, and you immediately take off your put side if that does it. Like I said, that jagged movement starts to go down again, and guess what? You don't have any puts that are making money. Okay? So you don't necessarily take everything off right away. Okay? You just find a use for options. As you become more experienced and there's more than one strategy you're looking at, you always look at options as, how do I find a usage for them? Okay? There's a way I can use it. So you kind of don't want to just completely get rid of something. Okay? You don't want to be in a panic mode. Okay? Sometimes you do want to be in a panic mode, but if you're constantly in a panic mode trading on your heels, you're not going to maximize your profitability. Okay? All right, so that's where it is. If you do nothing, this is what happens. If it makes a huge move, you're loving life. Okay? If it doesn't, you're hating life. Okay, first thing I think you want to look at in trading anything, whether it's a straddle, time spread, or just kind of, as you become more experienced, you're going to have positions that don't have names. Okay? Like those old Clint Eastwood, the man with no name, the position with no name. That's when you know when you're really experienced, when you're not calling certain strategies anything. Okay? But what's common in all of them is liquidity. Okay? If you can't, if it's not liquid, it's not going to work. Okay, so we'll just give a couple examples. All right. Let's look at. Okay, here's Sears. I was actually a market maker a couple different times in the late 80s and the early 2000s in this, although back then you had different stocks in the trading crowds, and the applied microcircuits was really the hot one. But we also made markets in Dean Witter and Sears. They were kind of the, old grandmas of the pit, but you could still make money in anything. Okay, and Chris, we're coming right up on this, will become, how do you mitigate theta loss on the straddle? Okay, theta loss, for those of you who don't know what, familiar with the Greeks, that means the fact that it's a wasting asset and the premium gets wiped out, goes to nothing. Okay, we're going to show you how to mitigate, because those losses are going to happen. There's no question that's going to happen. All right, the time value is going to get sucked out of the premium. Okay, but it may have a big enough move that doesn't matter. It's irrelevant, because the actual intrinsic value or expiration value meaning the value will be at expiration will be way outweighs whatever the loss of the time value is. Well, we're going to show you how, even if it doesn't make that move, okay? Previous example where we showed, the smiley graph that turns into that V and how depressing it is. We're going to show you how you can make money on that position, even if it doesn't do that, okay? But let's get back to liquidity here before we get sidetracked on that. All right, 3 things you look for in liquidity. All right. First thing, you want to see the volume of the underlying, and this is really kind of a sad stock. I mean, it used to be just, four of us market makers that have that much volume, just amongst us in a typical day, and the whole crowd would probably like 10, 12 people in there would, double that amount, and now it's just nothing there. And then you look at the volume. 3 things you look at: volume, open interest, and the volume of the underlying. Okay. You want to have something that trades at least 2 million shares a day. All right. Anything less than that, the odds are going to be against you. Okay. And then you look at the volume. How much is traded for that day? Okay. A 10 lot, a 10 lot, 30 lot. 12 lot. That's not good. Okay, that's terrible as a matter of fact. Okay, and then we look at the open interest. I don't think anything even cracks 500. Okay, of these, I think the highest is not even 300. Okay, that's terrible. Okay. But we look over the put side, we do have a bunch of them that are out of the money. I think these are just people are thinking, God, Sears just may go out of business. I'm just going to take a shot by 14,000 of these at this price. Okay. Well, what do all three of these things do? Okay. What happens is you wind up with this. If you have weak numbers on the first three, the volume, the open interest, and the volume and options, the volume in the stock, and the open interest is leg, you're going to have wide markets, okay? It's just not going to work, okay? And if you have a market like this, if you buy something in 1960 and you make, oh, I bought 5, I really wanted to cut back on a couple. You turn around, you got to sell it at 16.10. Forget it. That's just not going to work. Even if you're a genius, you're going to lose money on a stock like this. It's too bad. I mean, it was a great stock a long time to trade. Now, there are interior markets, but you have to dabble in it, figure out what it is. And even if there's interior markets, you still can't use a market order, okay? And sometimes you need to do a market order to adjust your position. There's just no two ways about it, okay? Here, market orders would be deadly. Okay, so we see this just doesn't work. Okay, I'll give you another example. That's what we have, by the way, at Option Authority. We have liquidity rankings for all different options, optional stocks and ETFs from 1 through 6. Rank from 1 through 6. 1 being the worst, 6 being the best. So I'm going to give you an example of a 6-star one. Okay, we'll look at the closest at the money, we'd say here. We have a bunch of them. Okay, so the volume has had 3,500, 5,600, 2,600, 4,100, 2,300. And then look at the open interest, 10,200. Now, open interest is if you buy 20 contracts in something, you haven't yet closed it out, that's thrown in the open interest hopper. Now, why is that significant? That's significant because that's another word for open interest is future volume, okay? So if you're looking to trade some options somewhere, you don't see good large open interest, that means there's no guaranteed future volume. Because there's 3 things you can do when you buy an option or sell an option. A, it goes in the money. If you're long it, you're going to exercise it. If you're short it, you'll get a sign. In either case, if it's out of the money, it goes out worthless. But the vast majority of times, people get out of their trade before expiration actually happens. Okay, so that's guaranteeing future volume, and it guarantees this. Okay, you gotta love that. Okay, 1 and 2 cent wide markets. Okay, right here, and here's tight as you can get nickel wide. Okay, if you have those type of markets, then getting in and out and adjusting your position is not going to call. The one word we all hate as traders is slippage, okay? All that does is reduce income, okay? We don't want that. So getting in and out of positions, if it's not a tight market, you're screwed. In essence, you're screwed, okay? All right, so that's just, I can't emphasize it much. Before you want to trade anything, a straddle on anything, or any type of strategy, always look for the liquidity first. All right, so our first example here, we're going to go, I know one of you wanted an example, okay, so we're going to give you some examples, all right? So the first one was this Monday, okay? You buy Twitter, June 38 calls, 25 times at $2.03, okay? So basically, that's $203 for each call you buy. Okay, the put, you buy for $2.01, that's $201 due each time, okay? So each straddle is going to cost you $404. Okay. Expiration in 47 days. Okay. The maximum possible upside profit is unlimited. That's these calls, okay? If this goes up to 100 and splits and goes up to 100 and split, you know, it keeps going up there. And by June expiration, you exercise the stock and, you know, still hold on and it can keep going up forever, all right? So anytime you're long a call, maximum profit's unlimited, okay? Maximum downside profit is 84,900. So not quite unlimited, but that's a nice piece of change, okay? Maximum possible loss, $10,100. Okay, so for that $10,100 investment, you could potentially rake in $84,900. What is the underlying price? Okay, the underlying price at about when this was put on was about, I think it was about right around 38. Okay, and I think it's a little under that right now. It's about 37.50. All right, it hasn't really moved around as much as you'd like, but the underlying price for what you're slapping these under, it's going to be the closest at the money straddle. Okay, so if the stocks, if the price is at 41, you're going to put on the 41 straddle. If it's 41.20, you put on the 41 straddle. If it's 41.50 and the next strike price is 42, then you flip a coin which one you want to put on. Okay, so that's what you look at for these. You look for the at the monies. Okay. So how is it that we make the 84,900? Okay. First of all, it's $4.04. Okay, we got the 404. That's what it costs. Okay. So it's got to be down or up from that. Okay. So then our downside break-even point is $33.96. Okay. If we do nothing, that is. If we just sit on our butts and are lazy, okay? So that's $33.96 per share. It's 100 shares. These options are, we're looking at 100 share increments for these. So it's $33.96 times 25, and that's where we get the 84,900. Everybody clear on that? How we get to that price? Okay. And next thing we want to look at as we establish the position is the at the money implied volatility is 38.76%. Okay. But basically that's just telling you what the premium level is. Once you establish a straddle, you want this number to go up. Okay. If it's not going up, you're going to get hit with that decay ahead of time. Okay, because that decay is going to happen between now and expiration. Okay, you prefer to wait a little while so you can help make some money off your position. How did I calculate the downside break-even point? That's a good question, Raj. Okay, we added the call and the put together. Okay, that's the $4.04 we have here. All right. So we just tack that on to the 38 for the calls. All right, because it has to get to that level, or so that if we exercise that 38 call, it's going to be worth $4.04. Okay, so it's just, so we go to 42.04. Okay, and the downside break-even point, we just subtract that $4.04. Okay, we wind up with 33.96. So that's how we calculate the downside and the upside break-even point. Did that answer your question? Okay, good. How far out in time do you generally buy a straddle for gamma scalping? 1 or 2 months out usually would be the max. Okay, there's anything within that. Otherwise, it's you can do it. It's just you're paying a lot of premium. You're more subject to what we were talking about. That implied volatility becomes more of an issue. All right, and if there's all of a sudden a big drop in that, you're going to feel the pain instantly. Okay, so you don't want to go too far out. Do you compare delta versus theta? You compare delta versus vega. Okay, we can't really cover that today. That's more you compare delta versus vega. Okay, good question, Mark. But yeah, it's vega that we look at. For those of you who don't know what that means, it's basically that's related to the implied volatility, the premium level for the options. Okay, because 95% of stocks, as they move up, the premium levels shrink, and as they move down, the premium levels explode. Okay, and that's, you look at the SPX or the spiders or the options on S&P futures, you'll find that that's the case. Okay, and because of that, that's why you would look at the implied volatility, which is incorporated into Vega, which is one of the Greeks. And so you want to balance that out with delta. But like I said, that's beyond what we can cover for today. Even I've got the extra 45 minutes. Even with that, that would be too much. But it is something we cover extensively in our get a little plug-in for our mentoring. Okay. So here's the here. Let's see. The Twitter, which we lose. Here, let me see. I think this is a different amount volume-wise than. Okay, so 10,100 is the most we could lose. Okay, and it's 47 days till expiration. All right. So what's 10,000 divided by 10,000 divided by 47? Okay. Tell you what it is approximately. Okay. Approximately, that's about $215 a day. Okay. So that's how much we're going to lose on theta. All right. That's how much the premium will. Yeah, Chris made the good point. If the stock just moves, stays in a congested area, moves sideways, will you lose on the theta? Yes, you're going to lose on the theta. Regardless, you're going to lose on the theta. The difference is that, so it's $215, okay? That's what it would be if you looked at it every single day that it comes on like that. That's not how premium decay works, though. Okay, it doesn't just, it's not an orderly thing like every day you come in and you get debited, your account gets debited $215, okay? In fact, right now, this is the amount that leaks out of your account on a daily basis for this position. $105, okay? The reason for that is that options decay exponentially, okay? Think of a ice cube on your counter. Okay, you're putting a glass of ice water. You break the ice, stick it in there. One of them falls out on the counter. You come back. It's just so it just begins to have a little sweat. So the ice cube's getting a little smaller. You walk back a half an hour later, it's down to almost nothing, and it just vanishes right before your eyes. So you can see it doesn't melt at the same rate. The less mass it has, the more it decreases, the more rapidly it decreases. Okay. It's the same way with the options. Okay. The closer you get to expiration, so it's an average of $215 a day. Currently, it's about $105 a day. For the last 2 weeks, it's going to be about $400 a day. Okay. And it's not going to be $400 per day. It's going to be picking up every day to that last week. So somebody asked, good question, when do we put these on? How far do we put them on? If you put them on with only a week left, you're going to have really rapid decay. Okay. I like to start them out like a month or so, a month to 2 months out. Okay. Doesn't mean you can't do that the other way. Okay. It decays really, really rapidly though. Okay. So that's one way to look at it is, okay, It averaged $215, currently $105. Last couple weeks, $400. So if you're making, on your gamma scalping, you're making $105 a day. Not quite a victory, okay? And remember, Saturdays and Sundays, you aren't allowed to gamma scalp, okay? Because the market's not open, all right? So if the market's not open, you got to do a little bit better than $215 a day too, okay? And we'll give it a few examples. A couple of them marginally okay type ones to do, okay? The third one's a home run, okay? Okay, so Mark's asking, is the idea to minimize theta? Well, we can't really minimize theta. Okay, it's going to decay, so we can't minimize that. We can minimize the effects of it by making money by gamma scalping. Okay, and we always hope for an implied volatility increase when we're long, but that's kind of out of our control. How do you define gamma scalp? Well, we're going to show you some examples of that, Rose. That's an excellent question. Without knowing fully what Greeks are, gamma determines what your equivalent share position will be at different stock prices. Okay, so once you understand the Greeks, you can actually place your hedge the night before all the way up and all the way down, and if it's filled, then you can put another order in. You can have that all mechanized beforehand. If you don't want to, sometimes when you have a little bit of intuition, that helps a little bit. Okay, sometimes it screws you up too, but more often than not, if you're an experienced trader, that intuition can help you. Okay. So that's how you would define gamma scalping. Okay, it shows you, like, remember before I said that you're long the call, long the put. As it goes up, the position becomes more like long stock. Gamma will indicate how much it's like long stock, or if it goes down, how much it's like short stock. Okay. And that will give you a clue as to how much to the upside stock you can short or to the downside stock you can buy. Be allowed to buy without killing yourself. Okay. Okay. All right, so here we have the graph of the Twitter, and here we look at Twitter's history. Okay, how much the stock movement of Twitter's history. Okay, so it's kind of down to this level here right now. In December, it made a big dip up, and then it shot way up to 52. So this is a volatile stock. Okay, that's its 6-month chart. Here it is at 2 years, so it's even higher at one point. So this right here is where it's been kind of for a while. Okay, so it has patterns though, like here. Okay, it can go a fairly long amount of time, but it kind of churns and grinds. Okay, if you're long that straddle at that time, it's going to be tough to make up the decay with your gamma scalping. Okay. All right, so let's we'll get back to Twitter. Okay. Let me see. So here's Twitter when we put it on last Monday. Okay. So what we're going to look at, when you're looking at gamma scalp, what you want to look at is the range in the stock. Okay, that's going to determine how much money you can make. Okay, so let's look when we first put it on. The high low, 38.96, 37.55. Okay, so that's like $1.41, I believe. Yep. So $1.41, that's good. Okay. Here's 38.61 to 37.36. Okay, that's $1.25, not quite as good, but still plenty. Okay, we're looking 37.78. That's $26. Okay, so it's you know, here it's getting a little smaller. Okay, less than $1. Okay, and here it shrinks even a little bit more, only 65 cents. All right, so it's getting tighter and tighter. Okay, so it's getting more difficult. These first couple days, though. Okay, remember that first day where it was $1.41. Okay, that $1.41, and I'll just say, without knowing what gamma is, gamma indicates what our equivalent share position, like how long we are with stock if it gets up to a certain point. So it's got a 450 gamma. Okay, so if it moves up $1, it gets more like 450 long shares of stock. Moves down $1, it gets more like 450 short shares of stock. That's so, without knowing exactly, like I said, I can't totally educate you on it there, but that's what it's like. Okay, so it has that opportunity. Let's say that $1.40, we don't exactly nail it exactly. We don't get the top and the bottom, but we still are able to get $1 scalping for the 450. We could make $450. Okay, on that day. Okay. On this day where it's at 65 cents, so it would be like 40 cents, we'd probably only make $160, $170. Okay, even if we'd made anything at all. Okay, so the smaller the range is, the less we're able to scalp that stock. Okay, so if we can get that $450, say the next day we got, you know, something like that. Now this is the range too. Okay, that shows what the top and bottom is. So if you're selling this, what do you think happens if that top and bottom, what do you think happens if that top and bottom, if it goes between that top and bottom, if it happens several times? Okay, if it's moving up and down several times, okay? What happens? Okay, then you don't get the 4. So in other words, it went down, went up, went down. Sometimes it'll do that 3 times in a day. So instead of 450, you're making 1,350. All right. Okay. So that's the thing. You not only want a wide range, but you want it to whip up and down. The more it does of that, the more you're just raking in the cash. Okay. So that's the way to look. Does that everybody follow on that? Okay. Can everybody? Okay. You don't follow on that? Okay. Because as it gets up to a certain high level, the gamma, which will indicate how much like long stock you are. Let's say it's 450, so it goes up. You sell 400 shares of stock. It moves down, you buy that back, and then it moves up again. You sell 400, moves down, you buy. You can do that 2 or 3 times a day. So instead of making 450, you're making $1,350. See how that works? Okay. Okay, I'll show you the Greeks and show you exactly how we do this. All right. Okay, here's a Facebook trade. All right. Here's a delta, here's a gamma. Gamma is about 7. Okay. For the 87. Okay, so 7. Gamma is about 6.5, and 6.5, so it'd be 13 gammas. Let's say we did it 20 times. That would give us a total composite gamma position of 260, which means if the stock went up $1, our equivalent share position would be 260 long, equivalent to 260 long shares of stock. So it went up a little bit. Let's say it goes up $1.25. We're approximately at 300 shares. Okay, so $1.25 up from here okay, at 79.75, we'd offer 400 shares. Okay, we get hit on that, and then it moves back to 78.51. We buy it back at 78.51. We've made that $400 profit. Okay, now it moves back up to that, and then moves back down. We're able to do that exact same trade again. And then if it moves down below 78.51, then the puts have more value than the calls. So if it makes $1.25 down, we can buy stock, and then it moves back to where it's at, we sell it out. This takes a long time to get this. I didn't, when I was only going to have it 45 minutes, I didn't plan to even get anywhere near this stuff. Okay. 10 contracts, so it'd be easy. Okay. All right, let's say we do the 77.50s, like I said, 10 contracts. Okay. Here's 6.5 and 6.5, adds up to 13. So it's a 13 gamma for one contract. Okay, 10 contracts, it's 130 gamma. Okay, so if it got up to like 80 cents, okay, we would be able to sell 100 shares of stock on this theory. Okay, and it moves back down, we buy that back for $100 profit. Moves down $1, we'd make it, moves back to where it was to begin, we've made $200 scalping. And the theta on this is like 5, 10, it'd be like $50 a day theta, okay? And yeah, we made $200 scalping the stock, okay? So we see the upside and downside break-even points we showed on the Twitter, okay? It may never get to either one of those, but if you're doing this on a daily basis, scalping your stock against this, then you can make more money on scalping stock than you'll ultimately lose on the decay of the options. So how do you determine to sell and take profits? I do it based upon the Greeks, okay? And even if you're doing it with technical analysis, you should have the Greeks as a good part of what you're doing, okay? But the technical analysis will let you determine how high or low you want you feel comfortable in letting the equivalent share position run. Does that answer your question, Mark? How do you sell stock for gamma scalping? You just go ahead and you just put it in order at a time. If it tells you, okay, at this level this is how many shares of stock will have the equivalent of being long because those long calls become more and more like long stock, that will tell you what to do. Okay. After you buy the straddle, what is your next step? You put in your orders below and above the market. Okay, that's your next step. Okay. You determine, you buy what the position tells you, what your equivalent share position will be to the upside and to the downside. You can put orders to buy below the market, orders to sell above the market. And if you get hit on it, you sell the stock, you immediately put it in order to buy it at a lower level. Okay. And the beauty of that is, the reason why that works is this. Rarely do you see this, but frequently you see this. Okay. And it might wind up at that same place, but that jagged movement is where you can capture those profits. Okay. In a nutshell, is gamma scalping a way to hedge long calls and puts using stock? In a way, it is, okay, but you don't need to hedge it. In other words, there's no unlimited danger to being long calls and long puts. You know what your danger is, okay? The premium you paid for everything, all right? So you know that, because you know that, what you're hedging against is decay, okay? Because you want to manufacture some profits to counteract the decay that's just a part of this trade. That's a natural part of this trade. Okay. And even if it never goes out of that range that you want it to be, okay, you can make money regardless on this trade. This is a delta neutral strategy, but you don't necessarily have to be, it's grounded in delta neutral strategy, but you can say, okay, I'm going to let it run to 400 deltas before I sell anything. Okay, and once it gets to positive 400 deltas, I may only want to take 200 deltas off. But you're right, Raymond, it is grounded in a delta neutral strategy, but you don't have to be delta neutral every step of the way. Okay. Yes, when you sell stock, you're shorting stock, but you don't get charged the margin for normal short stock because you have a long call against it. Because the reason why short stock has a high margin is because if it keeps running up forever, you're screwed, right? But if you have a long call against it, if you look at the graph of a long call and short stock, it's identical to a long put. Okay. Any advantage of paying less by buying strangles with a 50-cent spread versus straddles? I don't think so. I'm not a fan of being either short or long strangles. Okay. You want to go where the premium is. Okay. So if we're talking about long straddles today, but if you're selling straddles, I'd much rather sell where the premium is versus the strangle because, like I said, this gives you an early warning system as to what the risk is in your position. Okay. Can you do this in an IRA? You can, yes. How do you determine your delta target for taking profits? It's not so much for the delta. What you do is, as it gets to a certain point, you determine, okay, this is where I feel safe shorting the stock, or if it goes to the downside, buying the stock. Okay. Because if it keeps going down, I'm protected. I still have more puts, plus I have puts against the stock that I bought. Okay. And like I said, that jagged motion is where you capture your profits. Okay. If that jagged motion is too narrow, like that one example I showed with Twitter, it's really hard to harvest money out of it. So you could buy a straddle and all of a sudden it's just dead for a couple of weeks. That's very painful, okay, because there's not a lot you can do to defend your position in that case. But sometimes you do that and all of a sudden it just breaks out, okay? So if you have the patience, okay. All right, so that's, hopefully that gave you a little bit of a, okay, so we see Twitter, how it moves, okay? We realize that's a worthwhile one. Okay, now we look at Coca-Cola. All right. Now Twitter, their implied volatility, I think, is around 36. All right, it's not that different in price than what Twitter is. Okay, 38 straddle versus a 41 straddle. We see the price of this one. We're paying 72 cents for the calls, $1 for the puts. $1.72 is what we're paying for this in total. Okay, $172. Okay. So that adds up to $4,300 is our total risk. Can anybody tell me why they think the at-the-money implied volatility for Coke is 12.66 and with Twitter it's 36? Okay, here's a good question for you before we get into that. What do you think, what are your thoughts of buying, this is from Rod, what do you think buying straight calls and puts if you think you know the trend? You can go ahead and do it. Me, myself, haven't done this for 35 years. Whenever I think I know the trend, when I'm sure I know the trend, the market has a way of telling me that I'm not that brilliant. Okay, so, but if you know, I'm not saying don't do it. I'm just saying that's not what I do. That's not what most professional traders do. Like, so. Okay, if somebody's saying they cannot hear the audio, is that, can everybody else hear me? Is there any problem hearing me?
You're coming through fine on my end.
Okay, great, great. Okay, thanks. Okay, so can anybody explain why at the money implied volatility would be 12.66 for Coca-Cola, and then for Twitter it's way lower? I mean, way higher. The reason is it moves a lot more. Okay, the historical volatility for Twitter just moves a lot more. So the options, people, based upon that, they're going to pay a higher amount for the options, or they believe something is going to happen in the future. Okay, so we bought the straddle for Twitter. We had a, fairly large risk. The risk is way lower here. Okay, and the downside break-even point, the upside break-even point is also, it's not that far away. Okay, the problem is it doesn't move as much. Okay, so for every yin there's a yang. Okay, and there we see the upside and the downside break-even points. Okay, and we look at the history of Coca-Cola. Okay, so here we see 6 months from 45 to like 40 and a half. All right, it's not totally insignificant. All right, but it's not like Twitter. Okay, and there's a pretty rapid decline here though. That's a pretty big move. Okay, March Coke got beaten up pretty badly. For Coke, anyways. So we see these big moves, and we look at the dollar amount, like, oh wow, it's not that big. So, and here it is over the 2-year period of time. So there it's, even over a 2-year, we go down to 37 and up to less than 45. So less than an $8. The absolute dollar move, even though the percentage-wise it's a decent move, not huge moves. Okay, so therefore the premium is going to be less, but your potential for gamma scalping will be not as good either. Okay. How many days do you do this for before you sell options? That's up to you. I mean, if you're making money gamma scalping, okay, you're knocking it out of the park, then there is no set time where you have to give up on everything. Okay. Because if it's going wild, why not keep doing it? All right. But there's another thing too. If it is going wild, and if it's, let's say, it makes a big move to the downside, as we said before, the implied volatility increase, the premium levels increase. So you can either sell out the straddle, or you can sell, as you get more sophisticated, other than just doing the gamma scalping of the stock, you could sell the at-the-money options right there, wherever it happened to be trading at, and that would, in effect, it wouldn't get you totally out of the trade, but it would alter the nature of it significantly. Okay. All right, so let's just take a look at Coca-Cola. We'll take a look at that as well. How much that moved. Okay, so here's Monday where we established the trade, and then so you see 67 cents here, okay, and 52 cents, getting a little 52 cents, 30 cents, then it bounced back up to 60 cents, and then it shrinks down to 32 cents. Okay, so there's been a couple days where we could get some gamma scalping in here, okay, and the actual gamma for Coke position, the 25 times, it's 1,000 gamma. Okay, so if it every $0.50 move, you could scalp 500 shares of stock. So let's say you do that 500 and 500 shares, and be able to make it $50. You'd make $250. Okay, because the I think it's $91. Let's go back and look at how much the okay, so here we see how much we really need to do on it. So it's, if we divide this 4,300 divided by 47, it comes out to $91 a day total decay. Right now the decay is only $47 a day. Okay, so the last couple of weeks is going to be way higher than 91. Okay, and remember, we don't get to scalp on Saturday. Today, if you put in orders, they're not going to get filled until Monday. Okay, so we're losing 2 days of where we can compensate for our decay. All right, but yeah, if it makes that 50-cent move, you're able to do it 5 times. That'd be $250. Do that a couple days, you made $500. So you made you kind of staying even with it. Okay. What I'm going to show you next is an example of like just a dream scenario for gamma scalper for one of these positions, a long straddle position. Now this is Alibaba. I know one of you asked, is this a smart thing to do before earnings? Well, it's either smart or dumb, because you're going to get big movements with earnings announcement, but you're also going to get burned. Okay, because after that you are absolutely going to after this there's going to be a drop in the premium levels after big earnings. Okay, so what we did on Monday, bought the straddle for $8. Okay, expires in 47 days. Like we said before, upside unlimited. Downside, we can actually make $180,000. How do we figure that? 7,200. We look at the downside break-even point, 7,200 times the 25 that times we did it. Okay, that'd make $180,000 downside profit. Okay, if somehow something happened where they said, well, the Chinese government isn't properly making the bookkeeping and it's really worth nothing, who knows, it might happen. Okay. At the money implied volatility, 35.5, that was very high. It actually got higher between that and before the earnings day. And we'll show you, personally, I kind of like being long the straddles right up until the earnings day, and then I usually chicken out and get out of them and do another strategy. Okay, I don't know if you were here last time for the earnings strategies we did. Can't remember the exact Slumberjay and Facebook, I think we did. But yeah, so let's just take a look at. All right, so that's our upside and downside break-even points. Okay, remember the 88 and 72. Okay, so here's $88. Here's the $72. So we just sat here, did nothing, and it wound up at 80. We'd be screwed. Okay, but if it's within that range, we could still make money. But we're going to see what happened with this. Okay. And then, first of all, we want to take a look at history of Alibaba. It's actually been kind of oh, this is the one-day chart. Okay, so yeah, so what we're going to do now, we're going to take a look at the price movement over that period of time. Okay, we'll look at the historical prices. Okay, here we go. 81.56, 80.12. Okay. It's like $1.44. Next one, 89. Here we had a big opportunities for gamma scalping. Okay. $3.13, I think. Okay. That's terrific. All right, because our gamma is like 275, so for each dollar, so that's like 670, like about 700 we could make if we did the high low on this. We would have made 2,100, and usually don't get the high low, so would have made way more than that. Okay, and yeah, so we'd be way ahead of what our and then we see here that's about $1.30, $1.34 actually. Okay, and then this is the key. Okay, it closed at 80. So here we're making good scalps along here. Okay, made a lot of money. The earnings came out, opened at 88, 83. That's every long straddle's dream. Okay, it actually popped way below. So with this, and then not only that, we were able to sell the stock at that level where it opened, or maybe got a little bit higher. Then it drops all the way down to here. Okay, we could buy stock lower here. It closes at 86. All right, you could have probably made about 10 grand on that day, just trading your stock. Okay, not only being ahead of that, and then what do you have left? You have 6 weeks left where the position has already paid for itself. Okay, this is what you'd call a home run. Okay, so that's what you're looking for. Okay, when you're long Australia, you want movement. You want it up and down as much as possible. But if it's going to make a move like this, you want it to be overnight. Okay, because if you're doing your regular gamma scalping, selling as it gets higher, and then just makes a big gap move up, well, that sell you made. In other words, the sell price you might have made at 82, you made it 88 instead. I don't know if you're quite there yet in understanding how that works, but what technical indicators are you using for the high-low movements of the day? I don't use them. Okay, personally, I don't. Although it's something you certainly could use if you wanted to. I just look and see where the deltas are, and do I want to be that aggressive with the deltas, both in relation to the Vega and in relation to how I think the stock is trending. Okay, so I have nothing against it. I just think you can do this even without the technical analysis. Would an IB crush after the earnings? Yes, it always does, without a doubt. But if it makes a big enough movement, it doesn't matter. Do you close the whole position out when you get a reasonable profit? If you want to, yeah. Or there's so many different ways of extending profit that there's no reason to always think, I've got to get out of this position right now. You can. There's nothing against it. You can still make money. The idea is you want to make the maximum amount of money. For range, could you also use the ATR on that? What do you mean by ATR? What does the ATR stand for, Lori? Average true range. I'm not even sure what that is, to be honest with you. All I know is if stock moves if it moves certain here, I'm able to do this. Okay, and if I'm aggressive in doing that, I'll pay for the theta, and who knows, one day I might wake up and makes that big pop in a day. Then it's just icing on the cake. If you get 3 or 4 of those a year, it's great. But the idea is you want to scalp. Okay, maybe I will watch that average true range. Okay. The idea is you want to scalp enough to pay for your leverage. Leverage comes at a cost. Okay. So you have to find a way to chip away at that cost so that you can take advantage of that leverage. So if you can pay for the theta, it makes a big enough move, then you get the icing on the cake. All right? And the great thing about it doesn't really cost. It's not a costly thing for your position because you're just converting long calls into long puts when you're shorting the stock, or long puts into long calls when you're buying the stock. So that you don't get a big margin, disaster. If you're short a straddle, that's another that's another thing altogether. Then you will have some problems going along with that. Okay, so hopefully you got the basic idea of how straddles work. Okay, does anybody have any questions right now? That I know it's coming up in another 7 minutes or something, we're done. But anybody have any other questions on this strategy that you can think of now? How much is the minimum on your, like I said, whoever you're doing it with, I don't want to speak for any of the clearing firms, they all have different limits. Call them up and say, if I own 10 calls and I short stock against it, do you consider that a synthetic long put? Is a long call, then if they do, they said, well, you need 20, you need 25, you need 30, depends on what they'll say. Okay. How do I teach this in my webinar? We go over different things like this in our weekly options workshop. But really, when you want to really learn how to do this to trade like a professional, is our mentoring. Okay. And just to go over that again, for everybody that's here today, we're offering a 33% discount on the mentoring. Okay, this is recorded, Rick. Yes. When you sell stock to Scalp Gamma, how long do you keep it before you recover? You keep it as long as the equivalent share position tells you to, or however long you want to. Or if you use some of the technical analysis like the average 2 range, you can incorporate that. Japanese candlesticks, whatever you want to do, you're welcome to do that as well. Okay. Okay, so just go here, optionsauthority.com. Here's how the mentoring works. Okay, it's a one-on-one basis. Okay. Now, I hope you got a lot out of this today, and all of you asked terrific questions. I hope you understand it. But this, and I love that I got to do it for 90 minutes. But the mentoring works, it's 90 minutes one-on-one. Okay, so if you're, when I ask you a question, your voice is a little bit weak, I know you're not really getting it. Okay, now I can't really know what level you're at. Okay, because it's one-to-many. One-to-one I can tell. Okay, and then we'll just go at it. It's all a matter of building up muscle memory. Okay, and that's what starts you out at the lowest level and bring you up. Okay, so by the time you're done with this, you have the same knowledge as a professional trader. Doesn't mean you have to take on positions that a professional trader takes on, but you'll be, in terms of knowledge and ability, you'll be right there with them. Okay. Just like with the reads, using this GoToWebinar, we use GoToMeeting. Okay, so every session we have is recorded for you. And between sessions, and we meet every couple of weeks, and also give you exercises to do. Okay, in between each session, building up that muscle memory so that you can be on a par with a professional trader. Okay. You listen to that recording a couple times, you give you the exercise, you become a little bit more expert as you go along. So everything I said today would be like second nature to you. All right. And after you're getting the foundation, the fundamentals, then you build positions. I give you a protocol of 26 different variables to record on a daily basis. You learn these things, become second nature. The key to trading is you want it to be second nature. That's why you see a rookie quarterback in the NFL, he's dropping back in the pocket and he's stumbling around, okay, because he's thinking of too many things. And then he gets sacked. You get this veteran, drops back, steps up into the pocket and just fires, okay, because he knows what to look for, okay. The number of sessions you get 13 90-minute sessions. Can you make a living, again, with scalping around your straddles? You have to be very good at it, but yeah, absolutely, you can. Okay, 13 sessions at 90 minutes. 13 minutes, 13 session, and so it's about 20 hours of just pure one-on-one. Plus, if you have between sessions, if you have a question, you shoot an email to myself or one of the other mentors that has equal amount of experience. Okay, so here it is, 13 one-on-one sessions, each lasting 90 minutes, 20 hours. That's the most. You're not going to find this anywhere, okay? Anywhere. You can't find that much one-on-one attention anywhere. I know there's some places that go, oh, yeah, we'll help you, and if you have a question, we'll get you some coach to talk to. No, you're locked in for 20 hours of one mentor from beginning to end, okay? Now, on top of that, you get the 140-page options workbook and the 51-page options exercises. You get option trading 101 and option trading 201. Those are companion videos that go along with it. The daily tracking worksheet that gives you those 26 essential market value with the proprietary liquidity ranging over 200,000 optionable stocks and ETFs. Plus, you get 12 months of my weekly options workshop subscription service for free. Okay? So right now, and the good thing about this, it's money back guarantee. After a month, you think this isn't what I thought it would be. We haven't had anybody back out yet, but it's possible. Just visit optionsauthority.com/mentoring. Just go on, fill that out, and how many strategies are taught? Unlimited amounts of strategies. Okay? Everything that you've read about, plus ones you've never read about. Ones that you will be creating yourself by the time you're done with this. Is gamma scalping detailed in your workbook and videos? Not in the videos yet. We haven't completed that video. But in the workbook, yes. But also in your sample trading is where it's really done. Okay? So right now, if you're a good trader, you see an opening, you take it. Okay, here's an opening. Here's something that's way out of whack that's very undervalued. 33% off the one-on-one options mentoring. So just go to here, optionsauthority.com/mentoring.